All right, for this video, we want to have a look at the U.S. Series LLC and why it might be a viable alternative in lieu of using a traditional holding company structure to protect the various assets that are within that business. So we've got a variety of topics here that we're going to cover. We'll talk about the Series LLC formation, some of the mechanics about setting those up. And then we'll talk about the federal tax issues that come along with that, and then overall just some of the benefits and risks of using a Series LLC. So if we start with just a traditional holding company structure, just to get kind of a baseline as to what it is we're looking to replace, let's say we have a company set up here. We have your holding company LLC. This is just a standard Delaware LLC. And we have 4 individual owners of that company. Now, if the entity is going to invest in a variety of different assets, what you'll often see is the holding company will set up subsidiary entities underneath it. So the hold company is set up first, and then you set up LLCs afterwards that are all 100% owned by this holding company. And then each subsidiary entity will then purchase or invest in those various asset classes. So if we have something set up like this, where we have holding company LLC, it sets up a separate LLC subsidiary entity A, also a Delaware entity, and then that entity is the legal entity that holds title to or invests in real estate assets. And then you might do the same, a separate entity B and C. B opens, let's say, a brokerage account to invest in stocks and bonds, and then subsidiary entity E is used to invest in a hedge fund. Now, at this structure, what we would see from a tax perspective is the holding company LLC is a partnership for federal tax purposes, so it is filing a 1065 partnership return. And then all of these entities underneath, because they are wholly owned, so a single member, meaning this holding company, they are disregarded for federal tax purposes. So all the activities of these entities are effectively reported on this one partnership tax return. But because you have the separate entities set up for each investment, the assets held within each entity are essentially protected from any kind of liabilities or debts that might exist in the other entities, right? So this is a very common, very simple structure that you might see set up. Now, what are some of the drawbacks with this? Well, you've got to set up a lot of entities. So if we look at the filing fees and compliance section, so filing fees to get this set up, and this is at a minimum, right? We're not talking about legal fees or other accounting fees you might have to pay. But filing fees, if we have 4 separate LLCs, the Delaware filing fee is a base of $110 per entity. So we've got $440 in filing fees, registered agent fees for each entity, let's say $50 a piece. And then every year we have to file a separate annual report and pay that $300 franchise tax for each LLC. So you can see how the just annual report and filing fees, all of these items can stack up quite quickly if you use this type of structure. Now, the Series LLC, in essence, is designed to kind of replace this structure by setting up one LLC as the series, as a series organization, that is, and then you can create internally your own subsidiary entities, your own series, as they're referred to, and you can do so without having to actually open a new entity with the state. And so this will substantially lower your filing fees, your annual filing fees, the registered agent fees, and it's much easier to do so, right? So you can create these series by just executing an internal document. You don't actually have to submit anything with the state. All right, so let's have a look at an example Series LLC, and this is a multi-member one. So we're going to go with kind of the same fact pattern as we saw before. We've got 4 individuals here want to set up an LLC. And that LLC, as the series organization, is going to create a couple of series within it. So we have 4 members create a Delaware Series LLC. We have individuals A, B, C, and D. Series A is created to purchase that real estate investment, and all of the members want to participate in this series. Now, this is really important to remember. So when you create a separate series, it's not as if the series organization itself is the owner, right? You have to look through to the members and ask, well, who, if any of the members, want to participate in this series, and what are going to be those ownership percentages? So in the series organization, we have these 4 members, and these are their varying ownership percentages. And when they create Series A, the managing member or the manager goes to all the members and says, who wants to participate in this series, this venture? And so let's assume that Series A, for the real estate product, all of the existing members in the series organization want to become a member of Series A in the same percentage that they had at the series organization level. So individual A becomes a member of Series A, and B, and so on, and it's the same ownership percentages, so 35, 15, 20, and 30, as they have at this parent company or the series organization level. Now, they do the same thing with Series B, so they create a Series B, but in this series, not everybody wanted to participate. So individual A says, well, I'm not interested in participating in this asset class, the brokerage account. So he decides to not become a member of this separate series. And it's only the other 3 individuals, B, C, and D, that decide to participate. And they agree that they want to participate in these following percentages. And then lastly, we look at Series C. And same thing goes where individual A doesn't want to participate, individual B doesn't as well. And so only C and D want to become members of this series, Series C, and they do so in these following percentages. So this is one of the flexibilities with the Series LLC. The series can be created internally pursuant to the operating agreement. All of the members might get that option, participate in each series, but they don't necessarily have to. And for the ones that want to participate, it doesn't have to be the same percentage or pro rata based on their existing ownership in entity A, LLC. They can change it. So a lot of flexibility here. And again, what's happening here is you're only creating one LLC with the state. So you're filing the certificate of formation with Delaware. And then every time this entity wants to create a new series, they do so by executing the form of series designation, right? It's an exhibit to the LLC operating agreement. We'll look at an example later. And legally, under the Delaware statutes, each series is treated as if it's its own legal entity. So you get the same liability protections, the same asset protections across all these series as if you had done, what we saw in the previous example, where you just went ahead and set up an actual LLC that was owned 100% by the parent company. Okay, so now let's look at an example of how these liability protections work. So we have the same example we saw before. We have 4 members create this Delaware Series LLC, also referred to as the Series Organization, and they put $4.5 million in cash into it. Now, Series A is created to purchase the real estate, B is used to open that brokerage account, and then C is used to open that hedge fund investment, or to invest in that separate hedge fund rather. All right. Now let's assume that Series A here has a $1 million judgment levied against it. So let's say there was a problem, a tenant was injured, and then the Series A was sued because of this, and there's a $1 million creditor judgment that's levied against this series. So if we were looking at the balance sheets for each series, we could see here that Series A, let's say the total assets is $500,000. They've got that debt of $1 million now. Series B has assets of $2 million, and then Series C has assets of also $2 million. The liability protection here would prevent a creditor from collecting this $1 million against assets that are found within Series B or Series C, right? So that's the idea, right? The liabilities are debts of one series. can only be levied against the assets that are within that same series. You can't go across to the other series to try to collect on that judgment. So in this instance, the most that the creditor would be able to collect is that $500,000 worth of assets in Series A. So the $2 million in Series B and C would essentially be protected. Right? That's at a high level what these Series LLCs are designed to accomplish. So if you have a lot of different asset classes and you have liabilities that are foreseeable or could happen to any specific one, the other series are insulated. Okay, so now let's have a look at some Series LLC formation issues and then other qualifications. So when we talk about general LLC filing requirements, and so we're going to look at this from a Delaware perspective. So Delaware was the first to have Series LLC statutes. I think it was implemented in 1996, maybe 1997. A number of states have also jumped on board over the years. I think there's upwards of like 20 states now that have Series LLC legislation. But if we look at general LLC filing requirements, so in order to launch an LLC in Delaware, you need to file a certificate of formation. Within that certificate, you need to include the name of the LLC, you need the registered office, address, and registered agent name for the LLC. And you generally include a date of formation and effective date provision. If it's silent on that, then Delaware just stamps a date on whenever it was filed and processed. And filing fees, you're looking at a minimum $110 filing fee. And then the registered agent fees. The filing fee for Delaware entities can be higher if you're looking for expedited processing, but you're looking at a minimum of $110 to get that entity launched. Now, what about Series LLC filing requirements? Well, there's a lot of overlap, a lot of the same provisions, right? You still file a certificate of formation, name of the LLC, registered office, address, registered agent name, date of formation, and effective date. But the Series LLC certificate includes one additional provision. You need a notice requirement. So the Series LLC notice requirement effectively lays out that the LLC is going to be a Series LLC and it can establish one or more series under the Delaware Act. And there's a limitation on liability provision. So liabilities of a certain series can only be enforced or satisfied against the assets within that series. You can't use assets from other series within the series organization. And then the filing fees are the same. So we have a $110 filing fee, the registered agent fees, $50 to $200, whatever provider you use, so it's going to vary. And then lastly, and we'll talk about this later, but if you create a series and you want to register it with the state, there is a separate filing fee there. However, you don't always have to register. Right? We'll talk about the difference between having a protected series just generally, and then what it means to actually register that series with the state. Okay, so here's a sample certificate of formation that we might see if you're looking to launch a Series LLC. So we've got our certificate of formation. This is for sample company LLC. So we have the first provision, the name of the LLC, registered office, and registered agent address. We have the date of formation and effective date. And then we have the Series LLC notice requirement. Now, this is one of the things that I see done incorrectly more often than you would think, is people will form an LLC with the intent to create a Series LLC, but they leave off this Series LLC notice element. This has to be in there. Otherwise, Delaware will not create a Series LLC for you. They'll just create a general LLC. So we have notice is hereby given that pursuant to Section 18215 of the Act, the company has or may establish one or more designated series, and the debts, liabilities, obligations, and expenses incurred, contracted for, or otherwise existing with respect to that series shall be enforceable against the assets of such series only, and not against the assets of the company generally or any other series thereof. All right, so really, really important to have that language in there. And unless otherwise provided in the LLC agreement, none of the debts, liabilities, obligations, and expenses a contract for otherwise existing with respect to the company generally, or any other series shall be enforceable against the assets of such series. So quite a mouthful. What does that last piece mean? Well, within the LLC operating agreement, you can provide that series can share expenses or share debts, right? So the baseline general standard is if you have assets, debts, expenses attributed to a particular series, everything is contained within that series alone, unless the LLC operating agreement provides otherwise. So a common issue is expenses like legal fees or accounting fees. You might have, one accounting fee that covers the entire group, and then within the LLC operating agreement, it could say that all of the series are going to share in the costs of those accounting fees equally. Right? So then you incur the fees, you get an invoice, and then you allocate the fees across all the series. That would be okay, but that has to be laid out in the Series LLC operating agreement to provide for that a contingency. Okay? Okay, so here is some sample screenshots from the Delaware Secretary of State Register. So every state has a public database where you can search for entities. Some states provide more information or others, but this is a sample of what we would see with a Series LLC and a registered LLC. So I've grayed out the names of these entities, even though it's a public database. No point in putting that information in here. But this is basically what you would see. So on the left-hand side here, we have the Series LLC, the Series organization that was initially set up. So we can see the entity kind here, it is an LLC. It's domestic, meaning it was set up in Delaware. The incorporation date, formation date, and then the entity type here, really important to focus on. It's indicated as a series. Now, if you just had a regular LLC, it would say general, right? So a general LLC, but in this case, because we filed the certificate of formation correctly, we had the Series LLC notice requirement, you would see entity type as series here in the public database. On the right-hand side here, we have a sample screenshot of a registered series. So we'll talk about this in more detail later, but if you set up a series, a protected series, and you want to register it with the state, you can do so. And then when you register that series with the state, the entity kind will indicate that it is an LLC registered series. So it's not just a standard LLC. And then the entity type as well will indicate that it is part of a series. All right. So if you have an entity and you set it up and you're wondering whether or not you did everything right and you got a series or just a general LLC, you can check the public registrar to confirm the same. All right, so now let's talk about operating agreements. So every LLC should have an LLC operating agreement, even if the LLC just has one owner. That's always the best practice. But with Series LLCs, it's especially important to have an operating agreement because you need to outline, not only is it a Series LLC, but you want to include all of the provisions that show how you go about establishing a new series. So within the operating agreement, so at the top of the first page, you have those various recitals. So it's good to outline the intent here. So the parties desire to form a Series LLC under the Act, and the parties intend that the company may establish a separate series for the holding of investments acquired by the company, and then the debts, liabilities, obligations incurred should be enforceable against the assets of such series only. So a lot of the language, I wouldn't use this language specifically. There's a little more legalese that should go in there. But broadly, you want to see these kind of provisions in there. Now, the LLC operating agreement should contain a section that covers how you go about establishing a new series, right? So the managing member or the manager, if you have a manager, manage LLC, can establish a series in writing, and each series is going to operate to every extent possible or practicable as if it were a separate entity. Now, what about titling assets and liabilities? So title to any series assets shall be deemed to be owned by the series to which such asset was contributed or acquired, and none of the company, member, or other series, individually or collectively, shall have an ownership interest in such series assets. So that's a common thing to remember, is that if you are an owner of an LLC, you don't own the underlying assets, right? You have an equity ownership interest in the LLC. The LLC owns the assets within the organization. Tax-related matters, so company intends to be taxed as a partnership or a disregarded entity. So we'll go over the tax rules in more depth later. But because each series is treated as a separate entity for federal tax purposes, each series can make certain elections, right? So you can elect to be treated as a corporation. If the series is a multi-member series, then it's by default a partnership. If it has only one member in a series, then it's a disregarded entity. The form of series designation, so this is an exhibit to the operating agreement. It's basically kind of, you think of it as a standard template that is completed when you want to create a new series. So they'll have a section where you name the series, who are going to be the members, when it was established, how are the members going to share in profits and losses. And you could include, a statement to the effect of, what's the purpose of this series, what kind of assets are going to be acquiring, or what kind of business is going to be conducted. Okay, so now the difference between a protected series versus registered. So every time a series is created, it is referred to as a protected series. So this is a series created pursuant to the operating agreement. It's done by completing that form of series designation. And generally, as a best practice, the series should start with the name of the LLC, and then you can have a dash and then name the specific series. But it's not explicitly required that you do it that way if you just want to create a protected series that's not filed with the state. And then lastly, again, once these series are created, the LLC doesn't have to file anything with Delaware, right? You can just create a series and then you're good to go, right? You can use that series to apply for a tax ID number. You can open a bank account. You can purchase assets, borrow money. It is treated as a separate entity. Now, here's the difference with registered series. So a registered series is a protected series. You just have to take some additional steps. So the name of the series must begin with the name of the LLC. So this is one of the differences with just having a regular protected series. If you're going to create a series and you want it to be registered, it should start with the name of the LLC, because Delaware needs to be able to track to which series organization the registered series is attributable to. All right. Now, once that series is created, the manager or the managing member, whoever is responsible, files a certificate of registered series with Delaware, and they pay a filing fee. So registered series do incur filing fees, and it is now part of the public record, so it's searchable, right? If you just create a protected series, all of that documentation is basically just kept internally. There's no public record. But if you have a registered series, it is now part of the public record, so people can find it when they search within the database. Registered series do have to pay an annual franchise tax, so it's a $75 fee per registered series. In contrast, when we look at your standard LLC, remember that's $300 per year. So if you're creating series and you want them to be registered, this is going to be a cheaper option rather than just setting up a completely brand new general LLC and then paying that $300 filing fee. Now, a common question is always, well, why do you want to do this? Why would you go down the registered series path? Well, there are some cases where you're going to be doing business with a counterparty and they need to verify that the series exists, right? They need to verify that it is actually created. This is often an issue with lenders. So if you're trying to borrow money through the series, they're going to need to see that it is part of the public database. So here's a sample certificate of registered series. So we have, going back to our sample company LLC, So we have the name of the LLC. So this is the series organization is Sample Company LLC. And we are registering a series named Sample Company LLC Series A. So this is drafted, signed by the managing member or manager, whomever, and filed with Delaware, and that will create or register rather, your series with the state of Delaware. All right, now what are some of the federal tax issues? So this is where it gets really fun. So if we talk about LLC tax classifications generally, we have to look at the default rules and then what kind of elections are available. So LLCs, U.S. LLCs that is, are pass-through entities for federal tax purposes. So if you have a single member LLC, it's just a disregarded entity for U.S. tax purposes. If you have an LLC with more than one member, it is a multi-member LLC, and it is now a partnership for federal tax purposes. Now, LLCs generally are always eligible to file a C Corp election, so you can make that LLC whether it has one member or more than one member, you can file an entity classification election to make it taxable as a C Corp. Or in some cases, S corporations can, or LLCs that meet all the requisite requirements of having only natural persons as owners, U.S. persons under 100 members, can maybe make an S corp election, and that's done by filing the 2553. Now, Series LLC guidance, tax-wise that is, so there's not a lot out there because they're still pretty new. But we do have a couple pieces to look at. So there was a private letter ruling a number of years ago, which basically, in summation, it says that domestic LLCs will constitute a separate entity for federal tax purposes. We have a notice in 2008-19 with respect to segregated accounts and cells in the insurance space. So it was namely targeted to offshore jurisdictions. Very common, this type of series LLC or protected cell, segregated account, however you want to call it. Very popular in offshore jurisdictions like Guernsey and Bermuda, where you can set up separate cells within one entity. And that's really, really common in the insurance space. Then the stuff that provides a little more meat here are the proposed regs. So there's proposed regulations that were published a number of years ago covering series LLCs and cell companies. So that provides some more guidance. And then the American Bar Association, the tax session, commented on those regs and provided a little more color on kind of what they think, maybe the regulations should be changed or there should be some more clarification. So what did the proposed regs say generally here? So each series is going to be treated as a separate entity for federal tax purposes, and the default rules apply. So if you have a series that's a multi-member LLC series, you can have a partnership. If it's got just one member, it's a disregard entity. Or if that series itself decides to get an EIN and file an entity classification election, it could be a C Corp. It also established that the series organization, so that initial series LLC that we're forming, that entity is not the owner of each series. That's really important to remember. It's not as if you create a series LLC and then every time a series is created, it's owned by that series organization. It's the members of the series organization that come into each series, and those are going to be the owners. All right. Now, the proposed regs don't address the tax status of the series organization. So, in other words, if I jump back up here really quickly, bear with me. We're talking about this entity here. So this entity here, the series organization, the regs don't really address what to do from a tax perspective at this level. They make it clear that, well, as you have individuals or members come into each series, is it a disregarded entity, is a partnership? But you still have an LLC up here, and it has more than one member. So is this a partnership? Does it have to file a separate partnership return? Those types of issues. So not a lot of clarification on that issue, but the ABA comments do address it a little bit, and so we'll have a look at some examples and what you need to keep in mind. And then the last issue, tax ID number. So each series and the series organization itself can obtain their own EIN. And then again, each series can file an entity classification if it wants to be taxed as a corporation. And that is quite common. There's a lot of Series LLCs out there where they create new series and they want each one to be taxed separately as a regarded domestic corporation. Okay, so now let's look at some of the examples. So here's the first one that's in the proposed reg. So very simple, but it illustrates the kind of moving tax pieces here with respect to these series. So we have three individuals, A, B, and C, set up as Series LLC, so the series organization. And then the series organization creates a Series A and Series B. Now, Series A, the two members that participate that want to be members in this series are A and B, and they each own 50%. Individual C is the only owner of Series B because A and B didn't want to participate in that venture. So the proposed regs say that based on this structure, Entity A LLC Series A is a partnership because it is a multi-member LLC, and Entity A LLC Series B is a disregarded entity. So even though you've got, a partnership up here, you've got a partnership here, if only one member wants to participate in a series, it's a disregarded entity, unless Series B decides that it wants to file an entity classification election to be taxed as a C Corp. All right? Okay, so here's an example of what it would look like if everything was disregarded. So this is quite common where you just have one investor that is looking to set up this structure to protect all of these investments, these assets from liabilities from one another. So we have individual A here opens a Delaware Series LLC. So this is the series organization, and he is the sole member. All right. Then the series creates three separate series, and individual A, being the only person that's in this structure here, he becomes the 100% owner of Series A. He's the 100% owner of Series B, and also the 100% owner of Series C. Now, because you have just one person here that owns everything, all of these entities are going to be disregarded unless they file that entity classification election. So from a tax perspective, if you're thinking about the reporting here, individual A would do his Form 1040, and on his 1040, all of the activities within each series would just be reported on the 1040 on the appropriate form and schedule depending on the activities that are going on, within each series. All right, so let's go to the multi-member Series LLC. So we already kind of saw this structure on the previous slides, but just to recap what the federal tax implications would be here, we have 4 members open a series organization, and each member decides to participate in certain series at these varying ownership percentages. Well, Entity A LLC Series A, this real estate investment, everybody wanted to come on board in the same sharing ratio. So 35% for A, 15% for B, 20% for C, and 30% for individual D. This Series A LLC would require its own EIN, and it would file its own Form 1065 partnership return and give a Schedule K-1 to each member to report the income and expense and other items that are flowing through from this investment. And then the same goes for Series B and Series C. So Series B would need its own 1065 filing. It would have 3 K1s, right? One issued to B, C, and D. And then for Series C, also a Form 1065 partnership filing, and then a separate K1 for this activity to just D and then C. Now, the series organization up here, because the regulations are kind of silent on this, I personally recommend that this entity still files a partnership return, even though there might not be a lot going on in there. You could have, because all of the capital is going to be deployed down here. But if Entity A LLC, the series organization itself, has, let's say, a bank account, so there's might be only $5,000 in there, maybe it earns a little bit of interest. There are some expenses here. So arguably, unless the LLC operating agreement is going to push down all of those expenses to the series, it still makes sense, in my opinion, to file a 1065 at this level, even though there's going to be little to no activity, right? Okay, so in summation, this type of multi-member series structure, you would need 4 1065 returns. So 4 partnership returns for each of these series, and then the series organization itself. Okay, so now what if you're trying to simplify it a little bit more and you don't want to be doing 4 partnership returns, right? You want to kind of narrow it down to just 1. So this type of structure would require setting up an additional general LLC. So we have 4 members create holding company LLC. Now this is not a series LLC. It's just a general LLC. So this is your standard LLC filing a partnership return and giving a K1 to each person. Now once the general LLC is formed, the series LLC organization is then created, right? And it's created with the only member being this general LLC. So we have Entity A LLC set up as the series. Its only member is the partnership entity up here. Now, once that's completed, then you can go ahead and set up each of the series underneath. But in this scenario, because we have this general LLC in the middle, every time a series excuse me, is set up, the sole member that comes in is this general LLC above. So this entity owns 100% of A, it owns 100% of B, and it owns 100% of C. So all of these entities under here, because they have one owner, one member, these are all disregarded. So at the end of the day, with this type of structure, you do have the general LLC, you have a series, but you only need 1 partnership return. So you need 1 Form 1065 filing up here because all of the activities of these disregarded series flow up to the general LLC. All right? Okay, so now this was a structure that was proposed in the ABA comments, quite interesting. So in this structure, what they're trying to accomplish here is they are leveraging the idea that you can create as many series as you want within a series organization, and you can have different layers of series. So you can have a series that's created, and then underneath that series, it can create its own series organization. So if we have the same structure here, we have a series organization is set up first, and then the series organization creates Series A. And Series A, we have all of the partners come in. So individual A owns 35%, 15 for B, 20 for C, and 30 for D. So we have a multi-member Series A, which is filing a partnership return. And then this series organization creates Series A1, but it determines that it wants Series A1 to be owned only by Series A. And then they do the same thing for Series A2 and A3. So Series A1, 2, and 3 are going to be disregarded because it only has one owner here, the Series A multi-member entity. And so this eliminates those additional tax filings, right? If you're okay with everybody sharing in the same ratios, then this is another workaround to try to avoid having to set up this additional general LLC above. Now, that's just a proposed, structure. It makes sense to me. I haven't seen it used in practice, but that's a good idea if you're trying to create some series that are simply just disregarded, and you don't have to have all these members coming in and creating all these multi-member series that have to file their own partnership returns. Okay, so what are some of the benefits and risks of doing this? Well, the first benefit that you can see right off the bat are the reduced filing fees. So as we saw in the very first slide with that sample holding company structure, as you actually go to the state and set up all these brand new entities, you're paying filing fees, You're paying annual report fees to keep them open. You're paying separate registered agent fees. By setting up a series, there are no additional filing fees, right? You just set up a series, assuming it's not going to be registered. You don't need to pay annual report fees for each series. You don't have to you don't have to do separate registered agent fees for each of them. So there's a much easier or much lower kind of overhead with respect to setting up each series. And then the second point here, which is frankly, from what I hear, is just the primary benefit is the ease and speed of formation, right? So you can just fill out that form of designation agreement pursuant to the operating agreement, and you have a new series. You don't have to, you don't have to go to the state to file a document and wait for them to process it and approve it. Maybe you always do this by going through an attorney, and then there's the lag on when the attorney can get to drafting the documents and filing them. So very easy to just set up a new series in a matter of minutes. Now, so what are some of the risks, right? So like I said, I think Delaware started this first in 96, 97. A number of states have come on board since then. But they're still relatively new when we talk about the LLC world. So interstate recognition is a big one. So there's a lot of states that have Series LLC statutes right now, but many of them don't. Now, some states do not have Series LLC formations, but they respect the nature of a Series LLC. So Florida, for example, you cannot set up a Series LLC in Florida, right? It's just not possible. But Florida understands that Delaware has Series LLC statutes. So if you have a series that wants to register in Florida or do business or acquire assets in Florida, they respect the nature of that. They understand what it is. You just can't set up a Series LLC within Florida. And then there's some states that just flat out say you can't use them here because we have no idea what they are. So that's a big issue, right? You can set up a Series LLC in Delaware and create a new series, but if you want that series to do business in a state that just flat out doesn't respect it, then you don't have those liability protections, right? You're potentially exposing the entire group to any kind of liability or creditor exposure that might happen with respect to one individual series. Income tax treatment, so we covered some of these details. Again, there's still a lot of gray area, particularly with things like employment tax considerations, right? Do you have separate, can each series have its own employees? Do you consider all the series to be one employer because of the common ownership? A lot of gray area there. Banking and finance, so opening bank accounts, generally not too big of a deal with a series. It's easier if it's a registered series. That's certainly the case. But there's often some pushback with respect to certain financial institutions about opening accounts, borrowing money through a series itself. And then the liability protection. So as we touched on with the interstate recognition issues, some state courts, if they don't like or they don't understand the Series LLC structure, they won't respect the separate nature of each series. So if you have a lawsuit or a judgment or debts within one series, a state court might look at that and say, well, we're going to consider all the other assets within this entire group for purposes of satisfying those judgments. So something to be mindful of depending on where you're going to be using this Series LLC. So the Series LLC, you have to consider what assets are you going to acquire, what kind of debts or other expenses might follow, and then where are you going to be conducting business, right? Where are you conducting business? Where are these assets? What's the situs of these assets? Where are they located? And so there's all these variables that you need to consider. Okay, so that covers it for this presentation. I hope that was helpful. Again, not about 45 minutes here covering some various issues. I think I'm going to post some more in-depth issues with some Series LLCs at a later date, but I think this is a good kind of introduction to how these Series LLCs work and some of the various issues they need to be mindful of before you decide to go ahead and start implementing these strategies. All right, so that covers it. Thank you so much for watching and sticking through the presentation with me here all the way to the end. As always, very much appreciate your support, and I look forward to seeing you on the next video. Thank you.